everyone, and welcome to this session on leveraging finance for the transition in emerging markets and the role of banks. Thank you, everyone, for joining us in this panel. It's a great pleasure to introduce our set of speakers for today. So we have wide participation from across different players in the financial system, development banks, central banks, and the private sector as well in the panel with us today. So we have Sheila Mbijeve, Deputy Governor at the Central Bank of Kenya. Welcome. We have Leslie Mastorp, Vice President and Chief Financial Officer at the New Development Bank. Welcome. We have Marcus Pratt, Head of Sustainable Bonds and Finance at DZ Bank. And we also have Rodrigo Cuero Brilli, President of the Central Bank of Costa Rica. It's a pleasure to welcome you all. Before we start, let me hand over to James Zhang to give some introductory remarks.
Thank you very much, Diana. Good morning, good afternoon, good evening around the globe, wherever you are. A warm welcome to you to attend this important event to the World Investment Forum 2021. We have over 90 events in partnership with over 70 international institutions, including OMFIF, and thank you very much, Diana and your colleagues for organizing this event again with us. The last one we did was 2018, again at the World Investment Forum. Thank you. And we're honored to have this eminent panel, and this will be an interesting discussion. Allow me just get into the substance. I wish to share with you from our research, the most recent research, 3 tales with 1 message. The first tale is the public investment. The public investment is in recovery, and we calculated that out of the stimulus packages that there are $3.5 trillion were used for infrastructure, for project finance. That's the long-term aspect in addition to the rescue packages. And for that $3.5 trillion, unfortunately, developing countries accounted for only 10%. Net of China and a few large emerging markets is a very fraction for low-income countries in this recovery. Having said that, we know that $3.5 trillion investing in longer term development, that this public investment has a great potential to crowd in private investment. Our calculation is that probably it can crowd in $10 trillion. So it's 3.5 trillion that can crowd in 10 trillion. The second thing is the challenges of capacity of developing countries. They have a problem of pipeline bankable shovel-ready projects for their sustainable recovery and long-term growth. And the second key challenge is the governance issue. So that's about public investment in sustainable and long-term recovery. The second tale is international private investment in recovery. 2 days ago, we issued our Global Investment Trends Monitor, and we have seen the outlook for global FDI. In fact, the prospect looks much more optimistic than we initially forecasted. And in fact, we see for global foreign investment is a rapid recovery, but with growing divergence. We expect that by the end of this year, the global FDI will be fully recovered to the 2019 level, and this is like trade and GDP forecast initially, and normally we see a kind of FDI recovery is normally lagging 6 to 12 months. It's normally lagging in the business cycle, but this time we see this rapid recovery. Having said that, as I said, there's a kind of divergence. We see two divergences. One is that developing countries. The recovery of FDI is led by the developed countries because developed countries suffered the most in in the FDI decline. It was over 70% in 2019. So it couldn't be lower. I mean, this recovery is higher. The second, but for developing countries, the recovery is much slower. And particularly for the least developed countries, FDI flows continue to decline for the first half of the year. The other divergence is greenfield versus M&As. So cross-border merger and acquisitions is booming, while greenfield investment still tracing behind the trend. And in fact, greenfield investment for the first half of this year still remained at a very low level. International project financing has been increasing and growing. That's partly because of the stimulus packages at a global level that boosted the international project finance. Now, the third tail relates to the sustainability finance. As we monitored at the end of last year, reported UN General Assembly, the investment, public, private, and domestic and foreign altogether, the total investment in the sustainable development goals sectors, the key sectors, the investment intensive, lost from 1/3 to 2/3. And in fact, the decline in 2020 due to the pandemic has undone the progress made in the investment growth since 2015. So that is one aspect. The second aspect, interestingly, the sustainability themed funds have been growing rapidly. And even for last year, during the pandemic, the sustainability themed fund increased by 80% to $3.2 trillion US. And that includes 1.7 trillion of private equity funds with sustainability themes, and green bonds, 270 billion, and social bonds, another 200 billion, and then there will be mixed bonds for the rest of that. But having said that, we also see the divergence. In a sense, the overwhelming majority of the sustainability themed funds domiciled, invested in advanced countries. So less than 10% were are in developing economies. And the other thing is that this sustainability themed funds are mainly concentrated in renewables and to a lesser extent in the health sector. So it's not evenly distributed among SDG sectors. So what is the overall message? Is that we have overriding concern is that developing countries have a slow recovery, lack of investment, and lack of stimulus. And secondly, LDCs is even more difficult for the least developed countries. They are still having difficulties. The second worry is that there's a lack of investment in productive capacity at global level, and also in particular at the developing economies. I'm talking about the investment, the lack of green investment in productive sectors. So this is the overriding concern we have. Investing in developing economies, in sustainable development, in productive sectors. So this is the challenge I wish to put forward to you, eminent panelists, to seek your advice, your guidance, and to see what we can do at UNCTAD and what we can collectively do as an international investment for development community. Thank you very much.
Thank you, James, for setting the scene. That is very important. And as you said, emerging and developing economies are the ones who are being hit the hardest by a lot of those factors that we consider when we talk about sustainability, natural disasters, the slower effects of climate change as well, and also the ones least equipped in terms of resources to address them. And international finance, development banks, regulators in the countries themselves, and also the private financial sector have a huge role to play in terms of mobilizing resources for this transition, both in terms of mitigation but also in terms of resilience and adaptation, because even in the best case scenario of a 1.5 degree increase in temperatures, we are going to have to see a lot of big changes in economies and need to invest in those in adapting. Let me start the discussion now, and let me turn to you first, Leslie, because you are representing the new development bank, and multilateral development banks as a whole have a very big role to play in this transition. And maybe you can tell us a little bit about what you've done in this area very briefly for our audience, but also thinking about the toolbox that you have. And I know you have very interesting thoughts about this in terms of how this can be strengthened and how within the existing toolbox that multilateral development banks have, they can innovate and think about ways to support mobilizing finance. And James mentioned in the very beginning about how public finance and finance from MDBs can be complemented very powerfully by the private sector. So there's a lot of options on the table in terms of accelerating either replenishment, in terms of using balance sheets of MDBs more effectively, and also considering capital increases in some cases. So walk us through the toolbox, the options on the table, what you've done, and how you think this can be deployed most effectively.
Thank you very much, Danae, and thanks very much, James, for this collaboration. I'd like to start out by saying that the world is still in the midst of this global pandemic, and the one key lesson that we would like to extract as multilateral development banks is just how much the pandemic reinforced the important role of multilateral institutions, whether it be the G20, the World Bank, the IMF, New Development Bank. All of these institutions play during moments of crises. I say that today because we often take these institutions for granted, if you like, because markets in general, as you know, are pro-cyclical, and during the good times, no one thinks that at some stage there will be bust conditions. And if we did not have these institutions during 2020, the world would have been in a rather different place today. However, I think a case should also be made for a strengthening of these institutions, as you mentioned, Danae, to look at, are our toolbox still fit for purpose? Do we have to reinvigorate some of our existing instruments? And also look at honest reflection at what has not worked over the last number of years. Now, I'll just make three brief points in that regard. The first one is that in 2015, the G20 directed all of the MDBs to look at what they broadly called balance sheet optimization. It's kind of a fancy financial word. What it essentially means is, can you stretch your balance sheets more? Can you do more with your existing capital? There's a strong belief that there is spare capacity, too much cushions and buffers within our capital adequacy metrics, for example, which led the G20 a month ago to put in place a new panel that will assess the regulatory and capital adequacy metrics of multilateral banks. So next year, when Indonesia takes over the G20, that report will come out. The outcome could be that if, for example, those measures are changed, that the banks will have a lot more firepower. That's the first point. The second point to make is, and it's already been alluded to, that MDBs will shift their business model completely. The shift started a few years ago, moving away from public sector direct lending to governments, to state-owned enterprises, to using our balance sheet in such a way that we become more catalytic, that we use credit enhancement more, that we use our high credit worthiness. We are the only, and I may emphasize this, we are the only remaining AAA institutions in the entire world of finance. There's no JP Morgan, Goldman Sachs, HSBC, all of these banks, they're all either AA or AA minus, single A, and so on. The only institutions at the highest level are development finance institutions. We therefore need to use that high credit worthiness in more imaginative ways. And there's a search underway for what more we can do in that regard. So the second shift is more towards private sector capital, because as you know, Danae, there's large pools of savings, investors who have money trapped in zero, in some cases negative yielding interest rates, more than $10 trillion sit there, and yet we have bankable projects in emerging markets short of capital. So we need to bridge that gap, find a way to solve that paradox. And then the third and final point I'd like to make is that we are shifting our business models with almost 50% of our focus going towards climate finance. Most of the MDBs have announced, New Development Bank, we have a 40% target from 2022. all of our activities will be geared toward sustainable infrastructure, and we'll move away from traditional infrastructure, which we believe the private sector and others can finance. So that's kind of a brief snapshot tonight.
Thank you very much, Leslie. And I think the element of private sector mobilization is very important. I saw Marcus nodding there very approvingly, and we'll get more into that in the discussion as well. Let me turn now to the central bankers on the panel. And Deputy Governor Mijebe, let me start with you on the role of central banks, because central banks have become, some say, the new climate warriors. You've organized yourselves very well under the Network for Greening the Financial System. The Central Bank of Kenya has also been very supportive in terms of scaling up the sustainable finance sector in Kenya. But one of the roles that that central banks have relates to financial stability and protecting the financial system from risks, and climate-related risks are risks that are more and more being understood as sources of financial stability risk. And my question is, how do you see these measures that central banks have started to put in place, such as climate stresses, for example, in terms of assessing risk in the financial system? A lot of work has been done in assessing and understanding. Where do you think we go next from there? What can central banks do more proactively to manage those risks if they find out through, for example, climate stresses that there is a high vulnerability of the financial sector to climate-related risks? What can they do after that to mitigate it? Thank you. Are you?
Sorry, were you directing the question at me?
Yes, Deputy Governor, yes,
sorry.
to you.
Sorry, beg your pardon. I think I'd like to start by just putting some context around, and it was very interesting listening to the development bank position and obviously being aware of their high credit rating and also of the importance of their role within all societies. I think what we're saying is that, you know, the developed countries with the highest carbon footprint are bearing much of the burden, as was correctly said. A lot of the investment that has been raised and the money that's been used is in those areas. However, Africa must be committed to the agenda. It's very, very important that we remain committed. And we don't do it because it's an agenda that's driven by international bodies. We do it because it has a huge impact on Kenya, on African countries. And, you know, if I look into the future, when I think about the mandate of the central bank and stability of the financial sectors, you know, environmental crisis will really create a lot of instability. So it's not a wish for us, it's something that we must do. What has Kenya been doing? I think we've done quite a lot. We started in 2017 with the Green Bond Program, which the government signed up to. And following on from that, in 2020, we actually issued our first green bond. The governor of the Central Bank of Kenya is actually the patron of the green bond financial movement in Kenya. Unfortunately, the green bond was a student accommodation issued, released in January 2020. And so it's been very severely impacted by the COVID pandemic. And that has obviously had a negative impact. Kenya also enacted the Climate Change Act in 2016, and we've been on that journey. And if I take us out of the financial sector for a few seconds, you know, Kenya was one of the first countries in Africa to eliminate plastics, and that has had an 80% success rate. We gave ourselves 6 months to do it. Sometimes I listen to these other countries that say that they're going to do this and they have very long timelines. We gave ourselves 6 months. So far, it's 80% successful. Obviously, we have challenges of leakage and illegal importation of plastics coming into the country. We've also have an advantage for African countries. When we move forward and we're developing, then we don't have the past to hold us back. So for example, in renewables, in power, in electricity, Kenya's made huge strides. What we've tried to do is to focus substantially on all power, electricity, etc., being in renewables. We now have 88% of electricity is from renewables, and significantly in wind power, we've gone from 0% in 2016 to 12% in 2020. I think the thing that we're most proud of at the Central Bank of Kenya is in October 2021, so that's this month, we released a guidance on climate-related risk management for commercial banks and mortgage finance institutions. What this does is it really starts to integrate the concept of climate opportunities and risks into what we call the banking sector charter. And the banking sector charter has several segments to it, but the one that this falls under is ethical banking. And we give guidances on how to integrate the environmental issues. And it's also very important that the banks start learning now, develop the capacity to identify and mitigate climate risk, as well as obviously taking advantage of the opportunities. So as I say, Kenya has done quite a lot. The journey is a bit uncertain. It has not been helped by the COVID pandemic, but we think that we are a substantial player in this agenda. Thank you very much.
Thank you, Deputy Governor. And very important what you highlight about the opportunities for benefiting for developing economies as well, because there is at times a narrative that developing economies are not responsible for this, and therefore why should they focus on mitigation? It's the responsibility of developed economies, but there's also an opportunity to investing in this transition. And as you say, an opportunity to leapfrog as well and invest in a cleaner, sustainable development for economies such as Kenya. Thank you very much. Governor, over to you. Costa Rica is also a country that is pioneering in the area of climate and biodiversity in many dimensions. It is a country that hosts a big share of the biodiversity of our planet, but the central bank itself has also made a lot of progress in this. It was the first country in Central America to join the NGFS. And you yourself has shown strong leadership in that. But tell us about the question on risk mitigation and moving on to how can central banks protect and implement measures for the financial sector, as well as what the central bank has done.
Thank you very much, Anaya, and many thanks to OMFIF and to OMTAT for the opportunity. It's really a pleasure to share with you this morning or afternoon, wherever you may be. Early morning here in Costa Rica, actually. So let me start from the beginning, Danai, and in fact, well, it was a pleasure to hear from the previous panelists and from James and Leslie, and also from the Deputy Governor Sheila from Nigeria. It was actually very heartening also to hear from the donors and the development multilateral development bank from Leslie about their role and what they're doing. Also heartening to hear James mention about global FDI. Costa Rica is a strong recipient of FDI. But as you mentioned, Costa Rica is also a country that's been strongly committed to fighting climate change. And this is an opportunity also for me to share some of the things that we have been doing from the Central Bank of Costa Rica. In particular, as you mentioned, in 2019, we joined the network for the central bank the network of central banks and supervisors for greening the financial system, the NGFS, and that is already an important forum for us to share and learn about what can be done in terms of efforts to green the financial sector. I think a critical aspect of what central banks can do is to actually coordinate their work internally and with supervisors, regardless of the supervision regulatory financial model that different countries follow. Strong coordination between central banks and regulators is critical. Here, for instance, in the case of Costa Rica, we established an analytical group called the Group for Strategic Analysis of Climate Change, and that is following up on different developments and pushing forward the agenda in terms of climate change. So with them, they meet regularly. We have developed a roadmap to integrate climate change considerations into the design of monetary and financial sector policies. And here, the roadmap is centered around 4 blocks. The first is establishing reliable and comparable data, strengthening analytical capacity for scenario analysis, greening international reserves, and then promoting climate change risk management in the financial system. Now, let me start also here from the area of assessment, and I know you want me to go back beyond that, but first, assessment is critical, and for this, I think establishing reliable and comparable data is fundamental. So for instance, we've started to take stock of the required data to analyze the impact of climate change and to identify suitable indicators that can serve as a reference to measure and monitor climate change related risks. This is absolutely critical. Another area is the compilation of environmental accounts for a country. This is going to be very, very critical. Environmental accounts can actually can help develop hybrid indicators, for instance, in the interaction between environmental and economic variables, the interaction between biophysical and monetary indicators. And all of that can help indicate the contribution of natural capital to the economy and the potential impact of the degradation or depletion of natural capital. So here again, assessment is fundamental as a stepping stone towards climate change mitigation and adaptation. And I think this will be critical also in helping provide an information data set to assess the dependencies and impact of the financial system on ecosystems. And then finally, in the area of assessment, I think central banks should strengthen their modeling analytical capacity for scenario analysis, and particularly for climate change related scenario analysis. Here again, I think the combination of all these assessment capabilities is critical in terms of being able to help in the mitigation of risks. For instance, central banks can cross information on high-risk geographic zones in terms of, for instance, their vulnerability to flooding, high precipitation, or high temperature variability, with variables such as the distribution of production, credit distribution, or even the collateral being used to back up the credits. And here the role is indirect, but I think it would be important to generate a change in the resource allocation or in support the financial institutions can give to their clients in adjusting their production processes. And going beyond this, I think an area that is critical, and I think this is absolutely fundamental and is being done by many central banks, is of course greening their reserves. The central bank of Costa Rica has already moved to in a twofold direction. First, directly to create an investment portfolio that is environmentally friendly using greenness indicators, and the second is to invest in a green fund. And this is also being done by several central banks. And as you may know, the Bank for International Settlements has created a green fund that gives the opportunity to member central banks to invest in green opportunities. Banque de France, for instance, has also announced an end to investments in thermal coal industry by the end of 2024. And here, the ECB also has increased the share of green bonds in its fund portfolio to 3.5% in 2020, and plans to raise it further in the upcoming years. So just to give you an example, or a few examples of things that can be done from the perspective of central banks, going beyond mere assessment and directly into mitigation areas.
Thank you very much, and for highlighting the importance of measurement and assessment, because what you can measure, you can manage. And with climate, there is the issue of integrating those variables in modeling, which is not something that traditionally central banks have had to work in their models. Very long-term variables, tipping points, thresholds. This has all been outside the traditional economic models that central banks have relied on, but also the quality of data, which is something that a lot of effort is going into. Let me turn to you, Marcus, as the private sector representative on the panel. And how do you think the private sector can best work with the public sector in mobilizing finance for climate action? We heard earlier from Leslie about how MDBs can support and scale up private sector finance. But from your perspective at DZ Bank, where do you think the biggest gains are to be?
Thank you very much, Denai, and thank you very much for having me on this very interesting discussion. I mean, we are the second largest bank in Germany, and I think our role over the last years moved a little bit from a, let's say, classical financial intermediary to more a sustainability intermediary or sustainable finance intermediary. And hence we are working very closely together with MDBs, also with central banks in initiatives and so on. There are a couple of key things to consider. First of all, we should keep in mind what is our common goal in this discussion. And I think this is to close the sustainable financing gap. Yeah? And this sustainable financing gap not only consists on the often recited climate financing gap, we have also a kind of broader environmental financing gap. And then, of course, we mentioned this earlier, the SDG financing gap, for example. And there are, I would say, a couple of points where MDBs, central banks, and private banks can work together. One important thing is education and collaboration. Yeah, I think sustainable finance, you know, it's also a kind of learning topics. Yeah, we need to bring in knowledge also to emerging markets. We need to build finance partnerships. We need to build up multi-stakeholder platforms, for example. Yeah, because then you go a little bit closer to mobilize private capital. Then, of course, crowding in the private sector financing is very important. You know, it's the largest potential. Yeah, we as I always said, we cannot row alone across the Atlantic only with public capital. We need private capital to come on board at the end of the day. And of course, banks and MDB, we can partner up in creating markets in the way of uncovering new opportunities. I see the whole sustainability topic not only from a risk point of view, but also from an opportunity and challenging point of view. Yeah, we can of course deepening existing local markets, and we could mobilize private investors at the end of the day. Yeah, then of course it comes to a very important thing is there is no one fits for all solution when it comes to private sector financing. So we have to mobilize and leverage, let's say, different kinds of private sector financing, and also try to create a combined impact at the end of the day. I mean, the good thing is we have all the tools already at the hands, yeah, but we need to combine it and need to support it and use it to support the transformation of emerging markets. Yeah, you always have to find the right instrument or the right combination from instruments. Yeah, then one big question where we can help also together in collaboration with central banks, with multi-development banks, is of course the big topic of data. You know, we need to find somehow a common language in sustainability. You see the discussions here in Europe with a green taxonomy and the European Green Bond Standard. You know, still a lot of very different discussions, but at least that we have a kind of, you know, common framework, so everyone knows when we talk about sustainability what we mean with a green perspective, with a social perspective, and so on. And one also very, very big topic from my point of view is sustainability and innovation. Yeah, I mean, sustainability and innovation are not mutually exclusive. They go more or less hand in hand. At the Z Bank, for example, we are advancing the market with various innovations, also for the sustainable bond market, both for investors and issuers, which can be also used, for example, by MDBs. We have, for example, invented a kind of sustainability allocation tool where we can really make, at the end of a sustainable bond transaction, sure that the green bond or social bond will be allocated to portfolios with impact. Yeah, this is very important. I mean, our common goal should be to create impact, to create additionality. You know, very much often sustainable finance is a kind of refinancing things you have financed anyway. But I think together we are very strong to really create additionality in the market.
Thank you very much, Marcus. And I think also what you mentioned about the balance between different elements of sustainability is very important as well. And the opportunities, I like your framing about seeing this as an opportunity. And it is the growth story of the 21st century when we think about growth and development and economic development in emerging economies. That is the subject of our panel today. I'd like at this point also to encourage our audience to start sending through questions, and we will have the chance to integrate some of those in the discussion as well. But let me turn to some more questions now. And James, I think, would you like to make an intervention at this point?
Yes, thank you very much. It's really fascinating to hear the stories from the multilateral development banks and from national banks, from Rodrigo and Sheila and Leslie. I have one question. I see that the banks have been doing fantastic jobs, but in the meantime, we also work with the capital markets. For example, we work with the World Federation of Exchanges. We issued guidelines for exchanges, putting in disclosure requirements for the issuers, and all these guidelines in collaboration with Mark Kearney and also among this stock exchanges worldwide, because that's in the framework of UN's Sustainable Stock Exchange Initiative. The other aspects is relate to the security regulators. Even yesterday, we had a very good session with the IOSCO, International Organization of Security Commissions, and we are all mobilized our support, working with them also to provide some advice and guidance on how security regulators can promote climate change mitigation and adaptation. So the capital market is now on board and mobilized. And my question is, how can we create synergies between the banks worldwide, national, multilateral, regional, with capital markets, exchanges, security regulators, even private equity? I think Marcus has highlighted quite a few important points.
Thank you, James. Very good question. Leslie, maybe you want to go first on that one.
Sure. Thank you very much, and very sharply pointed question, James. Firstly, I think regulation has a very powerful and impactful role to play. The key requirement today, though, as you know, in order for us to maximize the potential role of capital markets to enable this transition, is for us to standardize regulation, taxonomies, standards. We have had a multiplicity of taxonomies across the world, which increases the transaction cost, which makes it more complex for investors to understand instruments. At the moment, new green and ESG compliant products will be curtailed by the lack of this standardization. So I think that is priority number one. There's a lot we can learn from the green bond market, in my view. In 2007, the first green bond was issued, right? Completely fringe instrument for at least 3-4 years until 2012. And then it exploded, exponential growth, and today it's north of $1.3 trillion. MDBs pioneered that instrument. There's a lot we can learn from that process, the role IGMA played, putting in place the green bond principles, which enabled the further growth. Now, we don't have the luxury of time today. We do not have another 20 years to develop new financial instruments. So the first and important element now, and Markani has given huge focus on this for COP26, is agreements among regulators, banking supervisors. And by the way, Bank of International Settlements already late last year came out with a piece called Green Swan, where they set out the power of regulation and the role of central banks in order to, if you like, engineer the greening of the financial and capital markets. The second point I'd like to make is that countries have different starting points. Capital markets are very underdeveloped in I'm from Africa, many of the African countries. So this differential situation between the developed world and emerging markets has to be front and center as we frame new strategies, because the biggest issue, I believe, or defining issue for 2022 is going to be cross-border carbon. And in brief, what that means is that, as you know, Europe has put in place, as part of the Green Deal, a carbon border adjustment mechanism, which effectively means that the carbon intensity of every good will be determined. When it reaches the border, a tax will be imposed. So the question is, who should pay? Who bears the brunt of the responsibility? Emerging markets have had less historical responsibility for climate situation that we are in. Developed world industrialized at a time when coal was very cheap, fossil fuels were very cheap. We do not have the situation now. What do we say to the 400 million people without electricity in Africa? We need to power those clinics and those hospitals and those schools. If no solar energy is available, what do they do with the coal in the ground? So the issue around just transition is the second issue that I believe we need to pay a lot of attention to, and it is central to the agenda at COP26.
Thank you very much, Leslie. And you've been making a lot of remarks about Africa just now. So let me turn to you, Sheila, on that, on the question of just transition, which is very important for a lot of economies that are transitioning, especially in Africa, looking at it globally, and also on the balance between adaptation and resilience versus just mitigating the effects of climate change, and how can central banks play a role in fostering that collaborative environment that James was referring to, working on the scaling up of sustainable capital markets. And you're on mute.
Thank you very much again for asking me to comment on this. And certainly I agree with what Leslie was saying. Just transition is going to be very important when we talk about a just world, when we talk about climate change. All of these things are part of the same story, ethical practices in an ethical world. So I'm totally in support with that. I think also smaller nations have an advantage. For example, in Kenya, the Association of Regulators gets together constantly. And we also have members of our body, our institution, on other regulatory boards. And so what you find is that there's an alignment then of what we're doing and an alignment then of the standards that we're introducing. So I think I see that as fairly competent. I know, for example, when we issued our first green bond, we worked very closely with our capital markets on those issues, and we worked very closely with our national treasury, and we worked very closely with the communication authority. So it's easier to manage these in a smaller environment. And you also don't have a history that you're carrying. You can go into it with a new energy and a new innovation in the way that you solve these issues. So I see that as being very, very important. I think the thing going forward is going to be cross-border. I know that African central banks spend a lot of time at BIS. I know we spend a lot of time interacting with whatever's happening there and whatever research work's being done there, and particularly on the digital. Kenya's been very active in that area. So what I'm saying is that let us continue to do that. Let's continue to grow it, because the standardization will be critical, As Leslie correctly said, what are we talking about? If we don't have an understanding of what we mean, then we're all going to go in different directions. Thank you very much.
Thank you very much, Sheila. Very important about also how much convergence in standards is optimal when a lot of the effects are local as well, and need to understand and measure how far convergence of standards is possible and is desirable. But also the experience of a small country, as you mentioned, is very helpful, I think, to a lot in our audience as well. Let me turn to you now, Rodrigo, on the role of central banks, because you were talking before about the greening of the reserves, for example, and what central banks can do beyond just looking at the financial stability and the protecting the financial system from climate risks, but also leading by example and showing through their own operations how they can contribute to that transition. So how do you think central banks, what role do they have within the broader ecosystem, with capital markets authorities, with other regulators, with private sector as well, to actively support the transition beyond risk mitigation in the financial sector?
Thank you, Sarah. Thank you very much, Danai. And I apologize, by the way, to Sheila. I mentioned Nigeria by mistake. I meant to say Kenya, of course. So apologies for that. I very much agree with Leslie and with Sheila on the importance of standardizing the taxonomy here. It will be critical, of course, to enhance investment by reducing transaction costs. This is absolutely essential. And I agree also with Leslie that we have much to learn from the experience of green bond issuances. I think, first of all, banks can lead by example. Central banks can lead by example. We've seen some or already a few instances around the world. The Bank of England, for instance, has made a commitment to achieve net zero emissions from their physical operations by 2050. So central banks themselves can help it directly in the mitigation area. But I think a critical aspect here of integrating, of helping channel finance, whether from capital markets, from multilateral development banks, from the private sector, is the area of risk management. And here, as Leslie mentioned, regulation will be absolutely critical. This regulation will have to be based on strong assessment. So again, the areas that I already mentioned, comparability of data, strong analytical frameworks, modeling of different climate risk scenarios will be critical. But we have to put this into stress testing methodologies from the perspective of regulators, so that we can understand well what the impact of different climate shocks could be on the real economy and also the financial sector. But I think most importantly, perhaps, is the pricing of climate risk. And here, prudential regulation can have a critical role. And it's an area where we're still all experimenting, but I think we need to really move to a place where financial regulators can establish the incentives for banks themselves to price the risk coming from climate shocks more directly in their assessments. And so, for instance, risk weighting in the assessment of capital requirements for banks should more and more integrate climate risks. This also should affect the way regulation is being done in capital markets. So clearly, again, the risks coming from climate shocks should help assess the value of different bonds or different securities being issued in capital markets. And again, the role of regulators in pricing adequately climate risk will be absolutely essential in ensuring the channeling of resources to mitigation, adaptation, investment opportunities. Thank you.
Thank you very much. And let me turn to you, Marcus, because we've been talking a lot about the ecosystem, but let's go a bit deeper and think about specific instruments. And I know you've done a lot of work on that at DZ Bank. How do you estimate the potential of sustainable bonds in emerging markets, and thinking also about types of sustainable bonds, because Leslie mentioned about the pioneering work of the European Investment Bank with issuing the first green bond in 2007 and the World Bank issuing the first climate awareness bond. But now we are also having target-linked financing linked to the SDGs, for example, and we've seen some sovereign bonds of this type in Mexico and elsewhere. We're also seeing transition bonds. So we're seeing innovation there, and the trajectory that Leslie described in the green bond market, which started as a fringe market and is now, it's still small compared to the overall fixed income market, but it's growing and has a lot of momentum. Where do you see potential for other types of sustainable bonds, and specifically in emerging markets?
Yeah, thank you very much, Dana. You're absolutely right. I mean, sustainable funding in emerging markets has great potential from my point of view. We have seen around green bonds from around 50 emerging markets so far, but there's definitely more to come. When I look at the use of proceeds, for example, one trend we currently see is diversification. There is a trend, green goes rainbow. This means the market gets a little bit more colorful. We see more social bonds, more sustainability bonds in the market. And this holds also true for sovereigns, for example. If you look at the budget of different states, yeah, you can always align a certain part of this budget to the SDGs. I mean, the big question behind there is often, do you only refinance things, or can you really create additionality of new projects? Yeah, but I think there's also, because you can also have forward-looking expenditures to put into an SDG bond, for example. Yeah, you have really, I would say, enough opportunities. Then, of course, in addition, you mentioned it, new structures like this target-linked bonds are emerging. The good thing with this target-linked bonds is that they are kind of forward-looking performance-based instrument. Yeah, you're defining some KPI and underlie them with some sustainability performance targets. Of course, you have to take care of some things. The KPIs you define should be relevant, core, and material to some way, measurable, verifiable, and at the end of the day, benchmark. And the SPTs you underlie should be a kind of ambitious. It should be not the usual business as usual scenario. It should go a little bit above. Yeah, but of course, you know, a lot of let's say emerging markets, sovereigns, supranationals, and then they already have some social targets, environmental targets, and you can easily use the already defined KPIs to structure a link of this. And let's think of Uruguay, for example, who have announced at the beginning of this year that they're thinking about issuing a sovereign sustainability linked bond. And then you're right, you mentioned the big question of transition financing. And this is where, from my point of view, a great potential lies. I mean, we cannot achieve a decarbonized world if we only focus on things which are already green and we paint them a little bit greener at the end of the day. We should also focus on all this, let's say, brown economic activities and business models and help them to be light brown or light green, yeah? Even if it takes some time, because the impact for the global sustainability agenda, is much greater. And from this point of view, we always say no one should be excluded from sustainable funding. And both types of bonds I mentioned, use of proceeds and target-linked bonds, are suitable to finance this transition. Use of proceeds, you can think, for example, you use your proceeds for dedicated technologies to make things less carbon intensive, for example. On the other hand, with a target-linked bond, you put the whole transition of the issuer a little bit more into the focus, when you choose these KPIs and the underlying sustainability performance targets. And we talk a lot to investors, and the interesting thing, among investors, there is a new credo when it comes to sustainable investing. And the new credo is transform instead of divest. In the past, many investors focused on strategies like exclusion or best in class, and those who do not fit in were sold. Now they are more and more looking for, let's say, the sustainable champions of the future, and identify sustainable issuers, companies of tomorrow. And they're going into an active transition dialogue, and they say, okay, we will accompany you as long as you're on a credible path of transition, and only selling those bonds or stocks is the ultimate ratio in this investment strategy. So we see there is a lot of things going on, change of investment styles, and transition is really key from my point of view.
Thank you, Marcus, for taking us through the rainbow. A lot of innovation going on. I'd like to give Leslie the opportunity to respond to that very quickly, and also go back to what we were talking about in terms of the role of MDBs in mobilizing and scaling up private sector finance, because that's something that has not been so far done to the best potential, let's say, for MDBs, and where there is scope to do it even more effectively. So very quickly on that, because I know we're close to the end, and I want to ask a final question to you all.
I just wanted to underscore, or if you like, reinforce the point that Marcus just made, which is critical. How will we deal with stranded assets? And let's be clear, stranded assets means stranded communities, stranded regions. Let me make it concrete. I come from South Africa. We have one province, Mpumalanga, where most of the 24 power stations in South Africa are located. 88% of our energy comes from coal. A number of these power stations reach the end of their lifespan, early 2030s, mid 2030s. 200,000 workers in the industry, 4 or 5 per household, to about almost 1 million people who will be affected. Who will be the custodians of these stranded assets as they lose their economic life? There's a debate right now, shouldn't public institutions like MDBs, for example, who could be better stewards of these stranded assets, for example, to take the lead? So these are some of the big challenges that Marcus has drawn attention to as part of the transition that has to be dealt with. To say something briefly about mobilization, Danae, this has been a key topic in the multilateral development bank system for at least the last 6 years or so. In 2015, there was a very impactful gathering in Addis Ababa. It's called the Addis Ababa Action Agenda, which set out this pivot towards the private sector, but has been mixed success over the years. We've learned a few things. Number one, we want to create the possibility of investment platforms so that we, on a syndicated basis, can bring in large institutions to participate. In short, it is very difficult for an individual asset manager, an Amundi or BlackRock, etc., to get involved in a big solar project in Kenya. They would be much more keen to get involved in a portfolio of projects in Africa where, for example, New Development Bank or Africa Development Bank, World Bank are the sort of partners in the selection criteria, the sustainability criteria of the asset is clearly defined so that they do not have to, get their own experts to understand the investment environment and so on and so on. So creating platforms where we can bring large institutions to commit much larger funds to, like the IFC has done, EBRD has done, that has the biggest potential for us to magnify the impact on the mobilization side.
Thank you, Leslie, and for highlighting that it's not just about stranded assets, it's also stranded communities, as you said, and stranded jobs, and there is a big role for the development banks to work on this. Final question to you all, very briefly, starting with you, Sheila. We are having this session, and in just over a week, the COP meeting in Glasgow will be starting. What are your hopes and your expectations out of this meeting?
I think coming out of the COVID period, what we've seen is the importance of collaboration, global collaboration. And I think if we haven't learned from that, it will be very sad. And obviously the climate issue is very much encompassed within that ethical way of thinking. Thank you.
Thank you. A test for multilateralism then. Rodrigo, over to you. Same question.
Pretty much the same answer. I fully agree with Sheila. Here, collaboration will be critical. But frankly, and we have to be humble, we're all learning. We're all learning in this field, and so information sharing is essential. And here, I think we have learned a lot from the network. I think also we have much to learn from the efforts that different central banks are doing, and here the network has been absolutely essential. The BIS has been also very helpful, I have to say, in this area of green financing and the approaches to regulation and supervision. But the global collaboration efforts will be essential. I think one aspect that perhaps we didn't emphasize enough in risk assessment and pricing is the role of credit rating agencies. I hope they get on board with these efforts, these collaboration efforts. They will play a very, very important role in mobilizing finance also. So thank you so much once again, Dana, for the opportunity.
Thank you, Rodrigo, and for highlighting that we are all learning in this, and we should not make the perfect the enemy of the good, because it is something that is very new. It is a common challenge globally. Marcus.
Yeah, thank you very much, Dina. And for me, COP26 is the successor of COP21, and we now have to be honest enough to see, to elaborate what has changed and what hasn't. And my hope is that we will see action, incredible commitments, that we really see new challenges, NDCs, and when we put them together, we are on the right path to achieve below 2 degrees or better, even the 1.5 degree path.
Thank you, Marcus. Yes, it is now from commitment in Paris to action and implementation in Glasgow. And Leslie, final word to you on this question.
As I said earlier on, I believe that the principles of the just transition has to be discussed front and center, and some commitment has to be made by the developed world. $100 billion pledge was made in 2015. Very little of that have actually reached the developing world, but a plan needs to be put in place to ensure that we do not leave behind stranded sovereigns, stranded governments, stranded people in this effort, because the developed world, in my view, have an historical, political, and moral obligation. Because, as I said, during the time when they developed and industrialized, coal was very cheap, fossil fuels are very cheap. We cannot hold back and slow economic development in the poorer, low-income countries because of the broader global challenge we face with now. We have to interconnect, as Sheila and everyone else has said. Global collaboration is important, but a bigger responsibility rests on the developed world from the resource transfer perspective.
Thank you, Leslie. So the goal should be climate, but also people and development, and these three should go together very much. Thank you all very much for your participation in the panel today on behalf of UNCTAD, on behalf of OMFIF and of the London School of Economics that I represent. Very grateful for your participation here. We've spoken a lot about international cooperation, about cooperation across different players in the financial system, and our panel today is a microcosm of that, of the different parts that make up global finance, development banks, central banks, and I look forward to continuing that collaborative spirit, because it is a common challenge to us all. It doesn't affect all the regions in the same way, and emerging markets are particularly challenged. But I liked Sheila's optimistic point that they have also the opportunity to leapfrog. They start with a clean slate in terms of innovating, and also the advantage of being small and being able to work effectively together and having the support of the development banks and the private sector. Thank you very much all, and good luck for the rest of the conference. Thank you.
Thank you, Dana. Thank you for OMFIF. And the next time we are going to bring regulators, policymakers, and capital market infrastructure executives together to have a dialogue. That'll be
and hopefully in person in
Geneva. We're really
Geneva.
grateful to have all of you eminent panelists. Thank you.